viewers. So today I'd like to talk about inflation, but not like we usually talk about with the CPI and the PPI, because the problem is when those indicators come out, we start looking at every single factor which caused CPI to go up and down, like kind of an elevator analysis. And so what happens is we lose track of what's really going on with inflation. So today we're going to do something different. We're going to first look at this guy. No, not me. This guy here, John Bolton. And he said politicians, like generals, have a tendency to fight the last war, the last battle. And not only I think is he correct about that, and he's talking about generals and politicians, but I also think he's correct about Jerome Powell, Jay Powell. He's fighting the last battle. And here's why. He knew what happened back in the 70s, right? Where inflation got out of control. But more importantly than that, he's worried about what happened this year. He took over 1 year to tighten monetary policy, to raise Fed funds rates. If you remember, what did he say? He said in response to a question that we're not even thinking of raising rates. And that's where he screwed up big time. He doesn't want to do that again. So because of that, this is what I think he's going to do. I think he's going to raise rates. He's going to keep raising rates, but not much. But then he's going to hold them. So like when you play cards, it's like you hold them or you fold them. I don't think he's going to fold them. He's not going to pivot yet. What he's going to do is raise and hold. And I don't think he's going to raise more than maybe 25 basis points for the next meeting. And then maybe another 25 basis points or nothing for the meeting after that. So we're talking about the next 3-month period, because there's going to be 2 Fed meetings, one in January and one in March. So I think this is all going to come to fruition by the beginning of the second quarter, maybe even end of the first quarter. And here's something else that I've got from my framework that people are not talking about. Ed Yardeni, who I think is great, is talking about soft landing. A lot of people talking about soft landing. I think because he's going to raise and hold, we're going to get a hard landing. Remember, there's a huge delay from when the Fed tightens liquidity and to what happens to the economy afterwards. So that's why I think we're going to get a hard landing, because the Fed's been raising rates quickly. And we haven't really seen the results of that yet. The only thing we saw the results of are the housing industry, which is, I was going to say going down quickly, but maybe I could even say crashing. If you look at pending home sales are actually down greater than they were during the great financial crisis, which is unbelievable, because I use the decline in housing sales during the GFC as like a downside case, because I don't think we're going to get that bad of a housing market this year, but it's going to be almost as bad, maybe half as bad. But that's the only place where there hasn't been a lag, where the Fed tightened liquidity and nothing's happened, because we've seen a lot of bad things happening in housing activity. And I'm just looking at my notes here. One last thing I want to talk about where I'm different from what other people are saying is that I don't think, and here's where we go back to history again, I don't think there's going to be a double top. People are saying that because we had a double top in the 70s and even I believe in the 1940s. And I think the analog for this inflation cycle is actually the 1940s. It's not the 1970s. But one thing I differentiate is I don't think we're going to have a double top like we had in the 70s. And I think we had that even in the 40s, even though I think the 1940s is the closest analog to what we have today. I don't think we're going to have some type of double top because of 2 reasons. Number one, debt to GDP is extremely high. And because of that, the economy is very weak and susceptible. So it's not going to be able to be as resistant to tighter liquidity as it has in the past. And the second reason, as people used to talk about, no one mentions it anymore, it's demographics. To me, demographics are extremely important. And demographics really, like Harry Dent used to say, it affects everything. It really affects everything: GDP growth, inflation. So we have a lot of debt. Total debt to GDP. Some people say it's 2 times, but if you put the total, it's about 4 times total debt to GDP. And demographics is pointing towards much lower inflation. But I don't. When I see inflation's not going to be that bad, and the Fed's going to be able to control it, I don't think it's going to go down to zero, not even 2%. The Fed's saying they're going to focus on getting back to 2% natural secular inflation. Well, I think they're saying that, but what they're really looking for is two-ish, meaning like 2 to 3% inflation. That's because it's in the interest of the government to have inflation because they have too much debt to pay back. So they need a debasement of the U.S. dollar. And this is why so many people like cryptocurrencies, especially the Bitcoin maximalists. They love Bitcoin because of what I just said, that we have huge debasement. If you're not sure about that, just look at the Fed's balance sheet. It's gone up sky high. It's only going down slowly now. It's hard to believe that it's going to go back down to where it was pre-COVID. So let's get started. That was actually my story, but I want to show you some data points on what's happening and how inflation is higher than expected, higher than should be, but why there's some hope. So let's get started. The first one is two types of inflation. The story here is that we have too much inflation. We had a 7% CPI. I'm not sure what this one. So this number might be different. It's probably here. Here we go. Oh yeah, it's 7.2. So this is a number that's quoted in the press. But if you go outside and zoom out, you're going to notice something, that goods inflation, and you can look at durables, for example, and that's in red, has already peaked. The peaks have been different depending on what data you're looking at. The peak here is about February, I suppose. But I saw some other peaks that showed April and May. But basically, the story is that goods inflation already peaked long ago, and it's going down rapidly. But the problem is services inflation. This is why the Fed needs to raise it and hold it. And you can look here, service inflation hardly peaked. I mean, this is a green line here, so that's the problem. So let's go to the next chart. And another reason why the Fed needs to keep raising rates is this. You can see that unemployment rate is only 3.7%. The Fed needs to create a recession. Why? Because recession, or true recession, is when inflation goes up and when people lose jobs. And that's the time when you really get lower inflation. So the Fed needs to raise rates because of lower unemployment rate, high sticky wages, and especially sticky wages, I should say, due to the services economy. So let's go to the next chart. And this one here shows you a bit of a dilemma. And the dilemma is this, that the Fed usually raises rates, meaning the Fed funds rate, above the CPI in order to reduce inflation. If you go back in history, back to the 1960s, 1970s, or all throughout the 60s and 70s, and then the high inflation, let me just move my picture here, high inflation of the 1980s, you can see that the Fed's fund rates even in some cases was not just higher, but as I'm pointing out, in some cases was extremely higher. The difference between inflation and the Fed funds rate was huge. And you can see here the Fed funds rate was about, let me try and get the top here. In May of 81, it was 18.5%. Yet the CPI was 9.7%. So there's a huge difference with the Fed funds rate being much higher. And you could see that in the years thereafter. But now it looks like there may not be enough because the Fed funds rate is below inflation. However, despite me giving you all the evidence that the Fed funds rate needs to be above CPI, I think if the Fed just raises rates a little bit and holds them, it's going to be enough to lower inflation because, as I said earlier, demographics and debt are the factors that are going to cause the economy to be and inflation to be much weaker. Remember, debt to GDP is so high that this is a monetized economy, meaning that a lot of companies are dependent on debt. There's a huge amount of refinance activity. So anytime interest rates go up, it significantly affects this economy. So the Fed does not need to raise rates. In this case, the Fed would have to raise rates to maybe 8, 9%. It does not need to do that, but it still needs to hold rates. And so that's what people may not be seeing. And now some good evidence going forward, as I mentioned already, demographics and debt are going to allow CPI not to be out of control. It's going to allow the Fed to be able to accomplish its goal of lowering inflation. And if you look here at the 5-year forward rate, you can see it already peaked. I think it was around April, May, that data point already peaked. And you can see it's at a very low level at around 2%. So this is a very good sign that inflation is not going out of control. Another good sign, and there's many charts that show this. I'm just going to focus on this one. And this is, you could get this on Yahoo Finance or anywhere. This is the Invesco DB Commodity Tracking Fund. And it shows you that commodities peaked way back in June, and they've since plummeted. And you could go look at oil prices. You could look at any commodity, lumber prices. They've already peaked. So that's another good factor. Yet another factor which you cannot see here is rent inflation. Rent inflation, and this is the actual data that's used to construct the CPI index. It looks like it's going through the roof. It just keeps going higher and higher and higher. But this data point on rent inflation, which is a huge proportion of the CPI report, this data point is many, many months lagged. So it's not shown that it's declining. So what you need to do is look at another inflation gauge called TrueInflation. If you look at that, you can see that inflation already peaked in March and it's going down quickly. And you could actually pinpoint housing. So if you look at housing, you could see housing is down 2.6% from a quarter ago, and it's only 6.3%. And you can see it's already peaked in April, but you're not seeing this data point and the official CPI report because it's, as I said, it's lagged. And if you look at transportation, it's plummeting. You could see it was 23% in March, and now it's only 1.9%. So there's a lot of you can go through each of these categories, which I'm not. But the point is, there's a lot of real-time data that the CPI is not picking up on that's showing that inflation peaked long ago and it's going down quickly. So I think the Fed is going to accomplish its goal. And here's a list of the next meetings, as I mentioned earlier. We got the January 31st through February 1st meeting of next year, then the March 21st through the 22nd meeting, and then the May 2nd through the 3rd meeting. So again, I'm looking for a 25 basis points raise for this meeting in January, maybe a 25 basis point raise again in March, or just hold them. And if they hold them in March, maybe they'll raise 25 basis points in May. But the point is, we're nearing that terminal rate. If you look at the CME, I love to look at this one. This is a CME Fed tracker. It shows you probabilities, and it shows you the dot plot. Here it's shown that there's a 72% probability of a 25 basis point rate hike for the next meeting. And then they've got the dot plot here where you could basically see the terminal rate, and it's going to be about 5%. And then it goes down quickly. So what you can see here, is that the market, no matter where you look at, whether you're looking at this data point from CME, where you're looking at forward rates, swap curves, you're looking at the consumer confidence index, all these surveys are showing that inflation is going to be under control. So you just have to be patient, folks. And I think the Fed's going to hold them raise and hold, and by next quarter, or maybe early second quarter of 2023, it's all over, and I think we're off to the races again, and we're going to see loosening liquidity by, I don't know, May, June of 2023. So I hope you enjoyed this. Don't forget to like us, because if you like us and subscribe to us, that's how we can continue to make these videos.